Hello, and welcome to this week's edition of Checks and Balances TV. I'm your host, Matthew J. Reddick, and I'm committed to giving you the truth you need to financially succeed. Each week, we'll review the news, check the facts, and provide balanced insight and unbiased advice to help you make critical financial decisions. So let's get up, get energized, and get going and see how today's headlines impact your financial future. Congress is getting back to work after the Thanksgiving recess, and taxes are the hot topic on their agenda. With just a few short weeks left until the expiration of the Bush tax cuts, lawmakers are trying to compromise. Republicans are fighting for tax cuts for all individual taxpayers, regardless of their income level, while Democrats support the expiration of Bush tax cuts for the top two tax brackets. Unless Congress acts fast, income tax rates will rise across the board, tax credits for families will be slashed, and tax rates on capital gains and investments will increase, all effective January 1st, 2011. In addition to tax rates, changes to tax deductions and credits have been up for discussion as well. In an effort to lead the country towards economic recovery, the Obama administration passed a number of tax incentives last year. However, many were introduced only as a temporary solution. Now the administration has asked lawmakers to make permanent tax credits that benefit some of the country's lowest income earners, while capping the tax benefits for the country's highest income earners. Okay, so what's really going on here? Let's check the facts using our checks and balances process. Throughout American history, there have always been taxes on income in one form or another. In our country's early history, they were in the form of excise taxes, tariffs, and duties. Until the turn of the 20th century, the federal government only collected money during times of war, as they left most of the governing up to the individual states. In 1861, during the Civil War, Congress imposed the very first tax on personal income in the form of a flat tax. It was 3% on all incomes higher than $800 a year. In 1862, a two-tiered income tax bracket was established. Taxable incomes up to $10,000 were taxed at 3%, and anything over $10,000 was taxed at 5%. By 1913, most states had accepted the role of the federal government and the 16th Amendment to the Constitution that allowed the federal government to tax the individual states. Tax rates began at 1% and rose to 7% for taxpayers with an income in excess of $500,000, which incidentally is equivalent to more than $11 million today. The Revenue Act of 1916 raised the 1% to 2% and the top bracket of 7% to 15% for people with more than $1.5 million in annual income. Throughout the last century, the income tax rate has seen lots of changes. Rates have been as low as 1% to as high as 91% and everywhere else in between. Social Security and Medicare withholding soon became standard federal deductions on everyone's paycheck. The number of tax credits grew, as did the number of tax brackets, as well as different categories of income. And over the last 100 years, income tax rates have gone up and down quite a bit. Today is no different. When Congress votes on the new income tax rates for 2011, they will decide to either allow the Bush tax cuts to expire, extend them for another year, or adopt a variation of both under President Obama's proposed plan. Since current tax credits and deductions ultimately decide what your final adjusted gross income will be and subsequently the taxes you will owe the IRS, this debate has everything to do with your end-of-the-year income tax liability beginning in 2011. The government rewards certain purchases and investments with tax deductions or tax credits and tries to encourage such behavior with tax incentives. Tax incentives are the government's way of enticing you to, as an example, buy a house, upgrade to an energy-efficient appliance, or save more for retirement. Quite often, they give you a tax deduction as the incentive. Tax deductions lower your taxable income and impact the tax rate you ultimately end up paying. Deductions are subtracted off the top from your gross annual income. Some standard deductions include contributions to a traditional IRA, student loan interest, as well as tuition and college-related expenses paid throughout the year. Now, after all deductions are subtracted from your gross income, which again is off the top, you end up with your adjusted gross income, or AGI. Tax credits, on the other hand, lower the taxes you would normally owe. Tax credits, by the way, are dollar-for-dollar reductions that are subtracted from your total tax liability that year. Some well-known tax credits include the Hope and Lifetime Learning Education credits, the Earned Income Credit, and the Child Tax Credit. Some notable proposed changes up for discussion in Congress right now include permanently increasing the child tax credit, which allows families with children under age 17 to claim a credit up to $1,000 per child. However, it's currently scheduled to be reduced to just $500 by the end of this year. The American Opportunity Tax Credit would replace the Hope Credit, which is a partially refunded tax credit applied to money spent on tuition and other scholarly fees for students attending school at least part-time. Okay, so you may be asking yourself, Matt, what does this all mean to me? Now that we've checked the facts, let's balance this news using our checks and balances process to determine what action you should take today. In regards to our country's history of taxing its citizens, it would do us well to remember that we've seen some of the same problems from the past resurface, sparking dissent in many heated discussions. Taxation without representation originated from the infamous Boston Tea Party and is now being heard again from the taxed enough already Tea Party. It's just another example of our country's long history of fighting for what we believe is fair and just. When the Declaration of Independence was signed in 1776, it established our country's beliefs that all men are created equal and that everyone is entitled to life, liberty, and the pursuit of happiness. However, many Americans today have a different idea of what that means to them and what fair taxation with representation means as well. Proponents for higher taxes believe there is a greater need for more government involvement to fund additional social programs and to give more financial assistance to the less fortunate. Opponents disagree. They believe that fewer taxes would encourage more small businesses to emerge and existing businesses to reinvest or expand their operation, which would then lead to more jobs and opportunities of employment for more Americans. If the Bush tax cuts expire, so will dozens of tax credits and deductions for all levels of income taxpayers, from those who need the assistance to afford quality child care to those who run small businesses and need to keep extra money on hand to keep their businesses afloat. Without some type of tax credits, working families will struggle to make ends meet, even more so than they do already. And small business owners may be taxed out of business, taking the jobs they created along with it. Okay, so what's the bottom line here? Admittedly, taxes are a necessity in a country as great as ours, but overburdening its citizens with taxes is not. Everyone should pay their fair share, nothing more and nothing less. Our founders never intended to punish those who work hard and reward those who choose not to work at all. This country was really built on the belief that we're all equal and have the same opportunity to pursue our dreams, no matter how modest or lavish those dreams may be. The American dream of success and prosperity can only come true if it's left up to the individual and not the government to decide. It's within your right to plan ahead and work to reduce your tax liability to its lowest legal amount. As the infamous Judge Learned Hand once said many years ago, anyone may arrange his affairs so that his taxes shall be as low as possible. He is not bound to choose that pattern which best pays the Treasury. My goodness, that's a great saying. And no matter what happens to our current tax rates in the future, be sure that you're using all the deductions, exclusions, and credits available to you to only pay your fair share of the tax you truly owe. In this week's CBTV poll, we asked Americans an important question. Do you think tax rates are too low, too high, or just right? The answers were A, too low. I think we should send more money to the federal government. B, they're too high. I think we need to keep more of our own hard-earned money. C, they're just right. I think we pay a fair amount to the government. Or D, I don't know. I don't currently pay any taxes. Well, 66% of you said that you think taxes are too high. Don't wait for the government to reduce your tax liability or extend current tax credits or deductions. Find out about the ones available to you right now by working with a competent and trusted financial advisor and CPA. In our On the Street segment, we travel the country to ask Americans what they think about an important financial topic or issue. For this week's segment, we asked people what they thought about income taxes. Do they think they're paying too much, too little, or just enough? And do they think that income taxes are going up or down in the near future? Let's take a look at what America had to say. Now, do you feel that taxes in the future are going to be going up or down?
I've never seen taxes go down in the United States.
Do you have a sense as far as income taxes, how much higher they're going to go in the future?
No.
But you do feel they will be going up in the future?
Absolutely.
What do you think about taxes? Do you think that as a business owner, individual business owner, that you're paying too much, too little, or just right in taxes?
I don't know. I think we're paying a little bit more than we should.
You know, there's an old saying that there's no guarantees in life but two, and what are they?
Death and taxes.
Yeah, that's exactly right.
Right.
Sometimes they say death is not optional, but taxes are. What do you think about our current income tax system? Do you think it's fair or unfair?
No, I don't think it's fair. I'd be in favor of a flat rate tax. I mean, there's got to be taxation. There's no question about it, but I think we're overtaxed. I know I'm personally overtaxed.
Well, going back to income taxes, it's interesting that income taxes in 1913, Congress officially made income taxes permanent. Any idea what the lowest tax bracket was back in 1913?
You know, I'd have no idea.
It was a whole 1%.
Really?
This next year, officially January.
Well, so what do I got to do to get in that 1% bracket?
we got to go back in time,
All
back
right.
to the future, like
Okay.
Michael Fox did.
Okay.
But this next year, taxes are going up. The lowest tax bracket is 10%. The highest is almost 40
All right.
at 39.6. So what's your feeling about these kind of taxes today on the federal level?
Well, I'm up toward the higher end of that tax bracket, and I'd prefer to be on the lower end of that tax bracket, but I don't see that happening.
It sounds like most people agree that taxes are too high, and this is during the era of the Bush tax cuts. It's more important now than ever to learn how you can reduce your taxable income so you can keep more of your hard-earned money. And now for Matt's weekly tip, tool, or technique. To reduce your total income tax liability, you must reduce what's known as your countable income, or your AGI, which is adjusted gross income, and increase your tax credits and deductions wherever possible. Consider the following 3 tax reduction strategies. Number 1, save more. If you're still working, you can always save a little more of your pre-tax dollars and put that money into a health savings account, a 401k, or a traditional IRA. The contribution limit for 2010 for a health savings account is $3,050 for an individual and $6,150 for a family. You can also contribute up to $5,000 into your IRA both this year and next year, and add an extra $1,000 a year if you're over age 50. Number 2, reallocate your investments. Consider restructuring your portfolio to include more tax advantageous investments. With the threat of higher taxes on the horizon, consider more tax-efficient investments, such as ETFs, mutual funds with lower turnover ratios, municipal bonds, fixed and variable annuities. Accounts like these can help keep more of your countable, which is taxable, income down. And number 3, convert your IRA. Depending on where you are on your road to retirement, consider a Roth IRA conversion. While you'd have to pay income taxes now on your traditional IRA by converting, you will not have to pay any taxes on the amount you withdraw in the future from your Roth IRA, keeping your countable income and taxes down at a time when you need the money most, which is retirement. Now is the time to realize that neither government tax cuts nor tax credits are solely responsible for reducing your tax liability. You are. And while you can't vote on the new upcoming tax code, you can change how you save and invest your money. Find ways to shelter your nest egg from unnecessary taxes and keep more of your hard-earned money now and in retirement. By the way, no one will ever care as much about your financial well-being as you do, but you must do your part. Mark your calendars for the next installment of our Truth About series. This upcoming episode will air later this month and is on the truth about mutual funds. You will learn the pros and cons, both sides of the coin on this important financial product, so you'll know if it's the right investment for you. And be sure to friend our Facebook page and subscribe to our YouTube channel to gain exclusive access to our library of viral videos and the lighter side of finance. For more information on how to become a checks and balances savvy consumer and to download any of our free reports, visit the download section of our website. Also, be sure to get your copy of The 3 Pillars of the Checks and Balances Life, a free report that gives you a guide for truth and accountability in today's challenging financial world. And while you're on the site, remember, your voice counts. Be sure to take this week's poll and visit our Tell Us What You Think section to share your opinion. Make your voice heard. And finally, remember that only you can control your financial future. You can succeed. You just need confidence and determination. I'm Matthew J. Reddick from Checks and Balances TV. Be sure to join us next week when we'll discuss how to protect yourself from holiday scams and con artists. Until then, spend less, save more, believe in yourself, and make it happen.